Hi, everyone. It's time for Live with Jim and Anna. Jim Ludwig and Anna Sugunina from Main Street Financial Planning. Anna, are you there?
I am here. Good morning, Jim.
Well, I'm sort of in my home office this morning. I can see you're in your office.
I
I
am usually in my office. Yes.
Well, the home office is downstairs. I'm in mid-level today, so I
As
can.
long as long as long as you're not in your car, we like that.
Well, I wish I was in front of the mission in Santa Barbara, but in a couple of weeks I will be.
Yes. We'll do the next broadcast from there.
Thank you.
Well, do you want to get on to our questions so that we can keep this to our time allowed?
our our alleged 15 minutes. Okay, so this is from a doctor who wrote in recently and said, should I roll over 403B, which is a nonprofit pension plan, and a pension savings plans to a Roth IRA? I'm a doctor and recently completed a fellowship where the income was 55,000. I'll be starting a job in January with an income of 250,000. My wife only works part-time. I have a 403B worth 1,500 from my fellowship and about 20,000 in a pension plan earning minimal interest. So tell me what I should do.
Yeah, I do like the idea of Roth IRA. Very frequently do we recommend rolling over a 403B in the pension plan in a Roth IRA. But I think for this particular person, why it's a good idea is because he's young, his income is going to go up, therefore his tax rate is going to go up too. And he has lots of time that will allow him to accumulate that tax-free growth in a Roth IRA. Plus, the balance of his pension, 20,000 in a tiny amount in 403B, make it all worth. Now, one of the things to consider is when you're doing this kind of rollover into a Roth IRA, we have to take into account taxes. So let's just, for example, say he may be in the 20% tax bracket this year. So he will, if we look at what the balance is and how much tax we'll pay on it, well, let's say maybe $4,000. So by next April, when he files his tax return, he needs to come up with $4,000, and then he's done. He's never going to pay a single tax on the growth that Roth IRA will have. So one of the things to say, okay, well, what is the situation like, and where do you take the tax dollars to pay for this? So one of the things was I was thinking that, okay, so the salary is going to go up to $250,000, so he can definitely maybe cash flow this expense. Sometimes we see clients take the tax amount out of the actual dollars that you're rolling over, but I don't think that's a great idea because that's going to reduce your balance. So I mean, it's a way to do it, but if you can cash flow it, I think that's probably going to be a better bet. So overall, I think it's a great idea. So yeah, just figure out where to take the tax, how to pay the tax bill.
The other thing that I would be sure to ask Anna is, does he have any other IRAs that
Traditional IRAs, right?
Yeah.
Okay.
Yes.
Right.
So
Yeah, it doesn't seem like it, but we can definitely confirm that if that's the case.
great.
Yeah.
So ask me a question, Anna.
Oh yes. Okay, so I know you're ready. Okay, here you go. Do I need a whole life insurance policy, Jim?
No, Anna, you don't, but a lot of people do.
Why
And,
don't
and
I need it?
let's cover
Okay.
some of the reasons why. Whole life is in a category of life insurance called permanent life insurance. They go under the name of whole life or universal life, and they're designed to last until the person dies, unlike term insurance, which expires at certain specified dates and time and doesn't usually last a person's whole life unless they die prematurely. Then that's why you have term insurance or life insurance in general. Anyway, there's a number of things, and I don't want to dominate the whole conversation today, but I want to basically tell people although life insurance is sold by some very energetic people, it isn't always the right solution, but sometimes it is, and I wanted to cover them. If someone's very wealthy, then permanent life insurance, whole life, might be purchased to pay for estate taxes. And many times that insurance policy is owned by a trust that the insured doesn't have access to, and therefore it stays out of his estate or her estate, and the money goes tax-free to the heirs and doesn't raise the amount of money subject to estate taxes, and it does provide liquidity to pay it, especially if there's a family farm involved or a business. That precludes them having to be sold. Also, the second reason is sometimes people need liquidity at death. And I'll give you an example of that. My pension dies with me, so I own whole life insurance to give my spouse, Carol, some capital at my death to make sure that she has enough money, because my pension, which I get from the Air Force, will cease when I die. And so if Carol predeceases me, then my kids would get the life insurance proceeds. So that's liquidity at death. Many times people have disabled kids or grandkids, and they need to take care of them forever. And so setting up a trust that has life insurance, whole life insurance inside of it, or permanent life insurance, would fund that, and it would not subject the beneficiary to a loss of government benefits. So that's another reason for permanent life insurance. Many times people will take a single life annuity rather than a joint annuity, and with the extra amount each month in the single life annuity, they'll purchase a life insurance policy, a whole life insurance policy, and then the spouse who wasn't part of the joint annuity would get the lump sum at the single life annuitant's death, or if the spouse died, then the children, just like in my example, would get the proceeds from the life insurance policy. That's a permanent life insurance need. Many older business owners use whole life or permanent life insurance to buy out a partner, or have the partner be able to buy out the surviving spouse. And it's usually term insurance is too expensive, or it's escalating. You can also put excess cash from a business inside a life insurance policy. A very sophisticated thing is people have highly appreciated stock. We have people that own Berkshire Hathaway stock, and they can give it to a charity. It can create an annuity, a gift annuity, and with that annuity, they can buy a life insurance policy, and it gives their heirs income tax-free death benefit to replace the stock, which had embedded capital gains in it. But a lot of times you can get even more value out of death proceeds on a whole life policy. There's a couple of more. I won't go into them right now, but that's a long list. There are many reasons why people need permanent life insurance. It's just not everyone needs it. Okay.
Okay, Jim. Thank you for the long explanation.
I tried to be as fast as I could.
No, you did good. Okay, before, just to hang on a second with your question, I just want to remind our audience that they can ask us questions live. So on your screen, in the left-hand side at the bottom of the video, there's a little link you click and you can submit a question. So I'm watching to see if there are any questions come in, and we can pick them up.
Great.
So we can move on.
So while you're waiting to see if anybody's going to ask us a question, I'll ask you a question. It's open enrollment time for many companies and the federal government. What should people be focused on at this time when open enrollment happens?
Yes, Jim, this actually has been on my mind all week. I keep thinking about this particular topic. So as you know, what we do is part of our financial planning is we look through everyone's employee benefits packages to make sure that they're taking advantages of the benefits that are provided to them by their employers. So there's a couple of benefits that frequently we see that clients don't take advantage of. So here's my top 3. Number 1 is health savings account or flexible savings account used for medical expenses. So I think more often we see that flexible spending account is available, but clients choose not to participate because maybe they don't have medical expenses or they don't have a lot of out-of-pocket cost. So therefore, FSA doesn't make much sense, because if you contribute to that account, you kind of have to use majority of the dollars that you contribute, or they go away. I think it's $500, correct me if I'm wrong, this year on, you can carry forward an FSA. Now, that's I see your head shaking. Okay. What's starting to be more popular now is health savings account. So I wanted to make sure that you also know that your employer doesn't necessarily have to offer health savings account. You can actually open that type of account on your own, as long as you have high deductible health insurance plan. Jim did on his show Swim with Jim, he did an interview with, and please correct me, Jim, with the top title of your interview, but it was about health savings accounts. And I think this particular one actually allows you to invest in Vanguard funds. Do you want to add something about that?
Well, I think what we'll do in the interest of time is we'll put a link to that show. It was a September 1st show. If people Google Swim with Jim Ludwig, they'll find my Blog Talk Radio website. But I think putting the link in the contact information down below will get right to it. And we interviewed one of the top people at, I think the website has been changed. Now it's healthsavings.com. So that is pretty easy to remember if people can't or won't find the link. It's a third-party payer out of Richmond, Virginia, so you know you're on the right website. And a lot of Garrett planners have used this company to help their clients, and that's where we met this gentleman at the Garrett retreat. There's lots of other vendors out there. It started off with mostly banks, though, and you really didn't get any cost-effective or any growth out of a health savings account, but now you can.
And so why are we even talking about health savings account? And Jim's kind of started on this, but the main idea is that if you contribute to this particular account right now, it allows you to take a tax, you get a tax deduction on your tax return. And then it's kind of like the Roth IRA that we discussed earlier. It grows tax-free inside that account as long as you use it for medical expenses. And it's not like an FSA, a flexible spending account. You can keep as much dollars there as you can. So it's just something to think about. We're starting to see more and more now, because you can invest not only in a savings account or a CD, you have options like Vanguard funds, which we like a lot.
So Anna, it's even better than a Roth IRA, because you're putting in pre-tax dollars rather than in Roth IRA. You're putting in post-tax dollars. You're putting in pre-tax dollars. It compounds, and as long as you're using it for qualified expenses, medical expenses, and especially in retirement, where there's a much greater chance of you having very high medical expenses at some point, you're really paying with inflated tax-free dollars, and it's a great way to save for retirement, because it can cover your medical expenses in retirement.
Yes, and I think this year, for 2015, if I'm not mistaken, I actually have to finish funding my FSA, but I think it's $6,500, something like that, close to.
Yeah, it's 63 and change, I think.
Yeah, or $63.50 this year.
Right. Your health savings account.
Health savings account contribution amount. Yes. Okay. All right. I got to cover two more things. So the second most, it's not an overlooked benefit, because for many it's something that an employer provides. But what's overlooked about this is this. And so I'm talking about disability insurance. Okay. A lot of times clients come through our doors and say, yes, I do have a disability coverage through my employer. Well, that's great. Okay. And so once we start looking through the documents and the pay stub, and so what we find is that they do have coverage, and it's a certain amount of their income. That's the second part of this sort of discussion I want to have. But the first one is, are you paying for this particular benefit with pre-tax or after-tax dollars? Because it makes a difference. If you're paying with pre-tax dollars for this coverage, okay, then if you ever gonna need the benefits out of disability policy, then it's gonna be coming out, it's not gonna be so pre-tax, it's not gonna be taxed. Pre-tax not gonna be taxed. If you're paying with after-tax dollars, you're rolling your eyes. Did I get that wrong? So if you're paying with pre-tax dollars, then you're going to be paying taxes. If you're paying with after-tax dollars, that your benefits are not going to be taxed, and that's what we want.
What happens if your employer is paying for it?
If your employer is paying for it, then you're going to be paying taxes on these benefits. So one of those times is when somebody says, "Oh, I have a coverage and it's paid for." Awesome, but think down the road. And sometimes you don't have a choice. Okay, stop rolling your eyes, Jim. I can see it. Distracting. Okay, so that's what I would like to point out to you all. Do make sure you have the coverage. A lot of times I've seen cases that, you know, you have the coverage offered to you, but you never signed up for it. So that is why open enrollment is a good opportunity to take a look at your book or a little PDF summary or wherever that is on somewhere on your employer's website and see what's available to you. And do send us a question if you're not sure this is something you need to have. And my number 3 item is life insurance. Now, that's something that we need to have a whole session just discussing how much life insurance you need to have. But a lot of times, you would probably get 1 times your salary or maybe 2 times your salary. Again, that might be paid by your employer. And there's no there's nothing you need to worry about as far as how the benefits are taxed once you receive them. But what I want to point out here too is, do think about, do you have enough coverage? Most of the times the answer is no, but I want to just bring that question up. Do you have enough coverage? And what we also find when we review all of these benefits is that you are probably better off going out and getting an individual policy, a private policy. It could be whole life, just like Jim discussed, if you have a need for it, but it could be just a plain term life, which could cost you a lot less. But the first question is, how much do you need? And do you, can you actually qualify for a private policy? So those are my 3 points for open enrollment, Jim.
We're out of time, Anna.
No, you have 1 minute to answer your next question. And so here's the question. When do I take my requirement minimum distribution, and where do I take it from?
Required minimum distributions are retirement accounts, and it's a whole bunch: IRAs, simple IRAs, SEP IRAs, 403Bs, 401Ks, all those retirement accounts that are pre-tax dollars. It does not include Roth IRAs, but all the other retirement accounts, you have to take out a certain percentage, which you use from an IRS table, but it works out to be 3.6% the first year that you turn 70 and a half. And you have to take it from 1 or more of your accounts after you've calculated individually how much has to come out of every account. Your custodian is usually going to remind you, but not always. And what's the penalty if you fail to do it? And this is a reason why people are asking me about their RMD. I'm asking clients about taking their RMD. It's because the penalty for failure to do it is 50% of the amount you were supposed to have taken. So if, say, you had $100,000 in your IRA at the end of last December, 3.6% would be $3,600. So the penalty for failing to take out that $3,600 from 1 or all of your accounts, if it added up to $100,000, would be $1,800. So that's half of the $3,600 you were supposed to take out. And you're going to pay you may be, if it's a big enough number, you may go into another tax bracket. So you have to be
More
very
tax.
careful.
Yes. I don't mean to interrupt. Continue, Jim.
I'm done. That's it.
Okay. It doesn't seem like we have any more questions that came through. So we'll post the link on Jim's interview for with the HSA guy. And then actually 2 episodes ago, we had a discussion about health savings accounts. So our August show, so take a look. That should give you a little more idea what they are and how you can use them. But I think we're definitely out of time. And so Jim, you have a wonderful weekend, and we'll be back in November. And make sure you're all cooking anything with pumpkin. So that's my plan for this weekend. I'm gonna cook something with pumpkin. I don't know what though, but that's
Well, I'm going to go Las Vegas and gamble my salary.
okay. Then I'm gonna be happy when you come back, because you're gonna be really enthused to work. So
Thank you. I will.
alrighty, take care.
Bye, everybody.
Thanks for listening. Bye.